everyone, and welcome back to Financial Podcast. I'm Olivia, and today we need to talk about something that sent ripples through the markets this week: bond yields. Now, I know bond yields might not sound like the most thrilling topic at first glance, but they are having a really significant impact on stocks and the economy, and understanding why is crucial right now. We're seeing major movements, and they're directly tied to some big news coming out of Washington. Just yesterday, the House of Representatives approved President Donald Trump's big, beautiful tax bill. This bill, which includes lower taxes and additional military spending, is expected to add trillions of dollars to the U.S. debt, with some estimates putting the price tag at nearly $4 trillion. It passed on a narrow vote, with every Democrat voting no. The House Rules Committee even convened for 21 straight hours to get it passed by Speaker Mike Johnson's deadline. Amendments included increasing the SALT deduction cap from $10,000 to $40,000. The bill now heads to the Senate, where it could face similar complications. This fiscal news sent shockwaves through the bond market. On Thursday, long-term borrowing costs for the world's biggest economies were surging. Yields on U.S. bonds, specifically the longer-term ones, climbed significantly. The yield on the 10-year Treasury note rose as high as 4.623%, the highest level since February. It was trading just below 4.6 later on Thursday morning. The 30-year Treasury note yield climbed even higher, reaching as much as 5.14%. These are levels not seen since 2023, and before that, 18 years prior. The fear driving this surge in yields is that the government will continue to ignore rapidly expanding debts and deficits. Third-party analysts, including the Congressional Budget Office and the Penn-Wharton budget model, say the administration's projections that the bill will spark growth and boost revenues are overly optimistic. Instead, they believe the bill is likely to keep the U.S. fiscal situation on its current trajectory, which Treasury Secretary Scott Bessent himself has called unsustainable. Now, before we dive deeper into the implications of these rising yields, I want to take a quick moment to ask for your support. If you're finding this information helpful and want to stay updated on these critical market events, please hit that subscribe button right now. And if you like this video, give it a thumbs up. It really helps the channel grow and reach more people who are looking to understand the financial world. Thank you so much for your support. The bond market's reaction this week follows an unexpectedly poor Treasury auction on Wednesday. Demand for the 20-year bonds offered was the lowest since February. Investors who did buy the bonds demanded a higher than expected yield, signaling they want to be paid more to take on the risk of lending to the U.S. government. This poor demand helped fuel the spike in yields and contributed to a drop in stocks on Wednesday. It indicates that investors' appetite for buying treasuries to fund the U.S. deficit might be lagging and could worsen if this tax bill becomes law after passing the Senate. Yields would need to rise further if bond demand continues to fade. This bond market nervousness isn't happening in a vacuum. It follows a debt downgrade of the U.S. last week by Moody's, which cited the deteriorating U.S. fiscal picture. Investors are warning that governments can't keep borrowing at the pace they did when interest rates were close to zero. This is particularly true because trade tensions and sticky inflation has lessened the probability that policymakers will dramatically ease monetary policy. A pullback by central banks and pension funds from bond markets also means a once dependable source of funding is increasingly absent. As Kathleen Brooks, research director at online broker XTB Limited, put it, it's no wonder that buyers are wary of feeding unsustainable deficit levels for the world's major economies. For decades, the U.S. was able to finance large entitlement programs like Social Security and Medicare by borrowing money at relatively low interest rates. Even as spending grew, rates remained low, partly due to the recession sparked by the 2008-09 financial crisis, which put the U.S. economy into a lower gear of growth. But the picture has changed since the COVID-19 pandemic. A further torrent of government spending helped push inflation rates to highs not seen in decades and has subsequently sent borrowing rates higher for the government and consumers alike. This isn't just a U.S. phenomenon either. Long-term bond yields are soaring globally. In Japan, 30-year bond yields reached their most since records began in 1999. Japanese 30-year yields were last seen around 3.184% on Thursday, while 20-year yields hit their highest rate in 25 years, around 2.598%. Bond auctions in both the US and Japan have run into tepid demand. Long-dated bonds in the UK, Germany, and Australia have also come under selling pressure. German yields have risen this year following the country's plan to spend billions on defense and infrastructure, with the 30-year rate trading around 3.16%. Pressure on German bonds is expected to increase as Berlin ramps up issuance, competing with higher long-end supply globally. As Shanil Ramji, co-head of multi-asset at PicDebt Asset Management, notes, there's clearly a lack of demand for long-end duration everywhere. The rising Japanese yields, for instance, pose a threat to U.S. Treasuries by making them less attractive to Japanese buyers. Paul Skinner, investment director at Wellington Management, explained that Japanese investors are pulling money out of the U.S. and back into Japan because they can now get attractive yields on their own domestic bonds without the currency risk. This move away from U.S. assets is being described as unprecedented by some. Some market watchers are drawing parallels with historical instances where bond vigilantes drove borrowing costs up so much that governments were forced to retrench, citing the U.S. in the early 1990s, the Euro area in the 2010s, and the UK in 2022. Just last month, President Trump even diluted his plan to impose tariffs amid what he called yippie bond markets. The question now is whether the bond market will freak out Republicans again enough to change the tax bill as it moves through the Senate. Treasury Secretary Scott Bessent, while acknowledging the debt situation is unsustainable, has seemed relatively unconcerned by higher rates and the Moody's downgrade. He argued on CNN that the economic benefits of the tax cuts will outweigh the debt problems they create. He also dismissed the credit rating downgrade, mentioning countries like Qatar, Saudi Arabia, and UAE, referencing investment agreements Trump secured. However, the Treasury will need to finance America's debt, especially once the debt ceiling is raised. If bond investors demand higher yields, it will make financing the debt significantly more expensive, potentially putting future safety net programs at risk, and leading to talk of big cuts to programs like Medicaid. Higher government borrowing costs don't just affect the government, they trickle down to businesses and households. This means people face higher rates on loans, curbing their ability to borrow or spend. Today, mortgage rates once again top 7%. Credit cards and auto loans have also become more expensive because the Federal Reserve has been forced to raise interest rates. Rising long-term Treasury yields are benchmarks for these consumer loans. So higher bond rates are going to make life more expensive for everyday Americans, potentially slowing down the economy and taking some of the power out of the tax cut bill, which is expected to juice the economy. This bond market stress is impacting stocks, causing them to drift this week. On Wednesday, the Dow Jones Industrial Average slid more than 800 points, and the S&P 500 finished the day 1.6% lower, its biggest drop in a month. Higher yields discourage investors from paying high prices for stocks. On Thursday, the Dow traded mixed, initially down 0.1%, but later up 80 points, or 0.2%. The S&P 500 fell 0.1%, while the Nasdaq Composite advanced 0.5%. The majority of stocks within the S&P 500 were losing ground on Thursday morning, but gains in large technology companies like Alphabet, which jumped 4.1%, and Microsoft, which rose 1.3%, offset those losses for the broader index. Beyond the major indexes, we saw some significant individual stock movements this week. Artificial intelligence stocks soared on the stock market on Thursday after the company's earnings report. Snowflake popped on an earnings beat and strong guidance amid an AI push. Advance Auto Parts saw its shares surge more than 30% after beating first-quarter expectations. Urban Outfitters stock soared 18% on Thursday morning after reporting stronger-than-expected quarterly results. This earnings beat comes at a time when tariff-induced uncertainty has mired the path forward for other retailers. Lumen Technologies rallied 9% after AT&T agreed to acquire substantially all of its mass market's fiber internet connectivity business. There were also economic updates on Thursday. The number of Americans filing unemployment claims last week fell slightly to 227,000, indicating the labor market remains strong. Continuing claims rose to 1.9 million, the highest level since November 2021. We also got the S&P Global data on services and manufacturing activity, which rebounded more than expected in May. Both sectors had readings of 52.3, showing expansion. New orders also rose, with manufacturing showing a 15-month high after a pullback due to tariff concerns. However, the report also showed price increases at the fastest pace since August 2022. These price increases were overwhelmingly linked to tariffs, although sentiment was boosted after President Trump backed off the most severe levies. The rise in long-term yields has negatively impacted bond funds like the iShares 20-plus-year Treasury bond ETF. The price of TLT, which has roughly $48 billion in assets, is down 8% since April 2nd and 9.6% since April 4th, which marked a brief tariff rally peak for the bond market. Bond prices fall as yields rise. The good news is that these funds do pay income, so total returns show smaller losses. The latest 30-day SEC yield for TLT is 4.90%. The surge in U.S. Treasury yields has prompted some market watchers to rethink the status of American government bonds as a go-to safe investment. Russ Mould, investment director at A.J. Bell, described the rise as relentless and a reflection of growing disquiet over swelling U.S. federal debt. He pointed out that half of publicly held treasuries, around $14 trillion of federal debt, will soon mature and need to be refinanced at higher rates. He warned that this situation, where higher bond yields mean higher interest bills, leading to more debt, potentially prompting efforts to loosen monetary policy, which could lead to higher inflation and even higher rates, is a classic emerging market trap, and both America and Japan are staring right into it. Given this shifting landscape, some investors are looking to diversify their fixed income allocation to other parts of the world. Chris Metcalf, Chief Investment Officer at Kingswood's iBoss, believes an allocation to global emerging markets debt makes absolute sense. He notes that while U.S. bonds offer a more attractive starting yield than before, the reasons for the increasing yield persist and have become more acute. John Murillo, Chief Dealing Officer at B2 Broker, adds that while U.S. Treasuries still offer unparalleled safety and liquidity, the historical notion of them being close to risk-free may need revision. He suggests various emerging market government bonds could be strong options for diversification. For example, he points to China's A1 credit rating with a stable outlook, noting that the yield spread with U.S. bonds makes it interesting despite tariff uncertainty. High-paced developing countries like Indonesia and Malaysia are also seen as potential beneficiaries, with a 10-year Indonesian sovereign bond offering around a 7% yield. Ultimately, there are only two main solutions to the U.S. fiscal problem presented by rising yields. According to George Saravelos, head of FX research at Deutsche Bank, either the U.S. must sharply revise the current tax bill to result in credibly tighter fiscal policy, or the non-dollar value of U.S. debt must decline materially until it becomes cheap enough for foreign investors to return. He advises to brace for more volatility. So, as you can see, the bond market is sending a powerful message right now. The passing of the tax bill, combined with concerns about debt, past downgrades, and global yield movements, is driving significant changes in borrowing costs and influencing markets worldwide. Keeping an eye on bond yields is absolutely essential for understanding where the market might be headed next. This is a complex situation, and it highlights how interconnected policy decisions, economic data, and market movements truly are. We'll continue to monitor this closely here on Financial Podcast and keep you updated. Thank you so much for watching. If you haven't already, please consider subscribing to the channel and liking this video if you found it informative. Your support allows me to keep creating content like this for you. Let me know in the comments what you think about the rising yields and the tax bill. I love hearing your thoughts. Until next time, take care of your finances.